So what's the future of Social Security? Plus, just how bad are those products that you hear advertised that promise all of the upside of the market with none of the downside risks? We're going to run the numbers on an actual example of a product that someone had that brought to our attention, and it had it for 16 years. You're going to be shocked at what the numbers are and kind of what's in the fine print of those products, which we'll get right to the chase. After all, those are equity indexed annuities, the most expensive, highest commission in the product in the business, which probably means that it's not that good for investors now, does it? Welcome. Of course, this is Dollars and Cents, where we help you make sense out of all of life's decisions that have anything to do with your dollars. We're Central Florida's longest running radio program, coming to you every Sunday morning at 9 a.m. on the News Radio Orlando WFLA network, and also 96.9 The Game. We also happen to be one of the top 25 financial planning podcasts on the World Wide Web, so be sure to subscribe to us on any of your favorite podcast channels or social media channels to know when we upload fresh content as well. My name, of course, is Joel Garris. I'm a certified financial planner and a certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful financial plan that will provide you with peace of mind for the future. So before we get to Social Security and annuities, we always like to start the program off with sort of what's the latest and greatest, because obviously the headlines these days are certainly evolving and shifting each and every week. And one of the things that we wanted to recap was some odd calls that we had got to the office just this past week from people who had completed their tax returns. And in this particular case, it had to deal with people that had to file trust tax returns. So maybe you find yourself as the trustee of a trust that had been set up, and perhaps it was set up for your kids or for another beneficiary to make sure that the beneficiary didn't get the money all at one chunk, that the money was paid out over time, and that requires you to file a tax return. Well, we do a number of those, as we do each and every year with our tax preparation service at the office. And lo and behold, we started getting calls from people we had filed a trust return saying that they had gotten letters from the IRS that said that they hadn't made the payment, that they had filed the return, but they hadn't made the payment, which is weird because we had, in a number of cases, we had the proof that not just the check was written, but also that it was mailed. And so we're really kind of scratching our heads on that one until we saw an article, courtesy of NPR, that talked about just how rough a shape the IRS is in. Now, of course, as you know, the IRS has a ton of employees, 70,000 at last count. And just like any business during this COVID shutdown, they had to go into a remote working environment. And so consequently, a lot of the stuff that has been being mailed into the IRS isn't actually getting open. The NPR article actually talked about the fact that the IRS has literally had to rent tractor trailer trucks and other storage facilities just to put all this stuff that it's getting in the mail and not opening, just to simply store it. So it's important to remember the disarray that the IRS is in as we're trying to mail in all of the information that you're required to file. As taxpayers, we still have to stick to the deadline. We still have to mail the checks in. And what's crazy in this situation that we saw play out this past week is a lot of the information that you get from the IRS from them is computer generated. So you've got their computers spitting out letters to these people saying, hey, we didn't get your money. the reality is that the check is probably sitting in an envelope that nobody's opened in a tractor trailer that the IRS has rented to store the stuff. There's some estimates that say that it'll take 1.5 years at minimum for the IRS to catch up with the backlog that has been created over the course of the past 3 or 4 months. So the message to our listeners is, if you get something from the IRS, certainly you don't want to ignore it, but understand that that letter is computer generated, and it may mean that you just hold on to it for a period of time. If you want to take some time and try and call them, that's an option, but understand that that's a very difficult process, because the reality is no one is on the other end of the line. So just know that some of the information you may get from the IRS may seem a little weird, but the importance of making sure that you've got proof that you mailed in a payment. To the extent you mailed in a payment, keep that proof, because you're going to need it come reconciliation time with the IRS. Also important to just have electronic filing and to have electronic debit. Although on trust returns, that's difficult to have oftentimes, because there isn't a lot of trusts don't have specific checking accounts where you can link that. So that's why this issue came up particularly on trust returns. So kind of an interesting example of how things are playing out in kind of these odd times. And certainly, speaking of odd times, if you look at the data that just came out in terms of the savings rate for the month of April, I don't know if you saw the number, but it was a crazy high number. The savings rate in America for the month of April was 33%. Now, granted, month of April, that was the peak shutdown period of time, and so a lot of people didn't really have many options to go and do and spend. But here's the interesting thing, and we think it's a powerful opportunity for folks to really think about their finances, think about their spending patterns, think about how they use their money. Because if you can jump your savings rate up to 33%, and then as things return to normal, as restaurants reopen, as bars reopen, as movie theaters reopen, as travel starts to reopen, maybe there's a way that you could kind of look at what you did during the shutdown period of time in terms of your dollars, and use that as an opportunity to improve your future, to build up your emergency savings account, to improve your retirement. Because in fact, if you can save 33% during a shutdown, the reality is then there is some discretionary spending that's happening. And after all, in order to save money, it becomes a feature of trying to tighten up how your discretionary spending goes. So as we've been quoted in the national media on this topic, it really has helped people really fine-tune what the difference is between their needs versus their wants. So as we come out of COVID, as we come out and the economy starts to reopen, we want you to take a moment and think about, how was I spending money before? How did I spend money when I wasn't allowed to, when I was forced into saving it? And try and change those habits to improve your future going forward. We'll be back after these messages here on Dollars and Cents with Joel Garris on News Radio WFLA Orlando. Back to Dollars and Cents. Joel Garris here of Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful financial plan that will provide you with peace of mind for the future. In our last segment, we were talking a little bit about those target date funds that are appearing prolifically in company retirement plans. And the latest data out, we've never been big fans of them, latest data out comes to us courtesy of Morningstar. The latest research, advice-based services within 401ks provide greater personalization than you can get with a target date fund. Again, something we've been saying on this program for years now, that the cookie cutter option choices of these target date funds aren't nearly as finely tuned as they could be if you take the time to try and look at all of the different investment options that are available to your 401k. The new data, courtesy of Morningstar, proves it. The research concludes not only do you save expenses, but you also see better returns. So take the time to review all of your investment choices inside your company retirement plan. Unfortunately, those can be pretty limited, but still check it out. And better yet, if you use somebody to help you with your finances, you should ask them to check it out. They should do it for free. And if they don't, then we suggest that you find somebody else that does, because that's a very important part of your overall financial picture. And you should certainly be getting that level of advice if you are using a professional to try and look at your overall financial picture. So we'll shift to Social Security. The 2020 Trustee Report just came out, and it once again looks very shaky, because when you look at the 2020 report, it is projecting a shortfall of nearly $17 trillion, that's with a T, trillion dollars, over the course of the next 75 years. What makes the 2020 report a little bit more worrisome than the 2019 report is that it projected a higher deficit than what they projected in 2019, and that was before the pandemic. So let me take a step back though and just say a couple of words here. A lot of folks assume that that means that Social Security as a whole will be broke, and broke in really normal parlance means that you don't have any money. That's not what this means. It means that they will not have enough money to pay benefits based upon the level of those benefits that have been currently promised. So it'll be there, it just will look different. And if we don't look at these solutions that we need to be looking at, it'll look very different. If we do nothing, for example, then that means in 15 years, the benefits would have to go down for current and future retirees under Social Security. The benefits would have to go down by 19%. That's a pretty big cut. Imagine saying to somebody who's living on Social Security right now, hey, we didn't do a good job with this program and we're going to drop your benefits by 19%. Would not be good. So clearly, over the course of the next few years, we're going to see and hear more of this conversation as a way to try and address that. Let's put why the program is under such duress on the table, and I think most people sort of understand and appreciate the numbers here. It's an aging population. The baby boomers are getting older. There's less workers. In that typically in the past there's been 3 people working, and then you're working and earning money, you're paying into the system. Today that number is not 3 workers for every person that is collecting benefits, but it's 2 workers for every person that is collecting benefits. So as you can well imagine, that'll skew the numbers pretty good. Reduction in fertility rates, lower interest, lower inflation, the economic data and the assumptions, and all of that, of course. Remember, the 2020 report was issued in May, which means that they had been working on it. It didn't really reflect the impact of the pandemic either. So certainly an issue that we need to be very much concerned about as Americans. We certainly want to make sure that that program is in the best possible shape, particularly for not just our future, but for the future payout or payments to current beneficiaries. So let's put some of the answers on the table, and some of the answers are answers that we've already seen them do, right? Increase the payroll tax is one, and we've certainly seen that before, and increase the age of full retirement. Those are certainly some options that we saw previously in other periods of time where they have made changes to Social Security to improve the finances. We think that those are certainly some that are on the table. But let's not also forget about what generates revenue to Social Security, and that is the payroll tax. And when you do the payroll tax, most people see that coming out of their paycheck, but there's another part, the employer part, that is a match of that amount that also goes towards Social Security. So as an employee, you have to pay 6.2% of your wages into Social Security. The employer matches that with another 6.2%. The reality is that if you wanted to completely bridge this gap, wave a wand and completely bridge this gap, one option is to increase that total of 12.4% up by 3.1% to 15.5%. Let me be clear, we're not advocating that, but expect though that some of that will happen along with a combination of other solutions that need to be implemented. Higher age requirements, particularly for younger people because people are living longer, and ultimately higher payroll taxes in order to cover that. But the other piece that you don't hear much about is that Social Security has a wage cap. So for this year, 2020, the wage cap is $137,700. What that means is that you only pay Social Security on income up to that level. If your income is above that, then you don't pay any Social Security tax. So yes, there's a major problem looming on the horizon. There are some answers, there are some solutions. If you look at the history of Social Security, you see that that payroll tax number has certainly gone up over time. You see that retirement ages has certainly gone up over time. And the reality is that for the past few years, we haven't really been dealing with it, and we've been kicking the can down the road. And I don't know that we can necessarily kick the can down the road that much longer, because the longer you kick the can down the road, the greater the problem is going to be. So I think it's going to be a combination of solutions. And again, the sooner you get those solutions on the table, the better off you are. The reality is that you ain't seen nothing when you start to look at Medicare and Medicaid. Medicare and Medicaid, we talk about the shortfall in Social Security. The projected shortfall in Medicare and Medicaid over the next 75 years is 7 times greater than a shortfall in Social Security. So we clearly got some issues that we need to work with. There are solutions. We've certainly implemented some of those solutions before as a country, and I think it's important to get that conversation on the table, because the sooner you figure out an answer, the better off you will be, and it won't be as difficult of a solution in order to get these programs back on track. I'm sure we'll be talking more about that in the years ahead, because that's going to be a continuing problem. That's why you stay tuned to the program and why we're back here each and every week. This has been Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. This is Joel Garris on News Radio, WFLA Orlando, 96.9 The Game. Just how bad are these things that you hear advertised all the time that talk about there's an investment product that you can have that has all of the upside of the market with none of the downside risk? And some of them will even talk to you about bonuses that you'll get simply by putting the money in. You ever wonder kind of what the numbers are behind that, how those products actually work? Because at the end of the day, you can't really get all the upside of the market with none of the downside risk. I mean, can you? It just seems kind of odd, right? Well, there's a lot that doesn't get explained, and oftentimes what we find is that investors get into these products on the promises, but the fine print always trips people up. So we're going to talk about a very specific example of this type of a product and give you some actual numbers. So welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions that have anything to do with your dollars. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where Our team of certified financial fiduciaries stands ready this week to help you change your life with a successful financial plan to provide you with peace of mind for the future. So you hear the ads, you ever wonder kind of how it works? We're going to look at a very specific example of someone that found themselves in this product back almost 16 years ago. So we've got the statements for those of you who are joining us on our YouTube channel at Nelson Financial Planning. Here's the actual statement. We're holding it up for the video screen, and it is a product that this particular individual, female individual, invested $80,000 back in May of 2004. So this is your very traditional equity index product that you hear a lot about in terms of the ads. It came with a 10% bonus, right? Isn't that fantastic? It came with a 10% bonus. So that seemed appealing. And so the problem is that when you look at the numbers, this is where it starts to get confusing. So this person invested $80,000 into this annuity product back in May of 2004. She gets a statement May of 2020, and in May of 2020, it says that the ending current value is $226,000. Now here's the thing. It says the ending current value, but if you're looking at the statement, that actually is under the bold headline of annuitization value, and then the statement further repeats it as annuitization value in bold. So understand one of the little tricks that's happening with these is that they are confusing the investor. They're confusing the investor by using these terms interchangeably: current value, accumulation value. Those values are basically insurance company values that you don't have any right to get access to the chunk of money that is represented in that. What you do have a right to get access to is this other number down here, which is called the cash value. The cash value is how much cash you could get out of it if you need it. The annuitization value is the value that you could use to annuitize. What does it mean to annuitize an annuity? It basically means you're taking the entire lump sum of money and converting it over to an income stream that pays out over a period of time. So you've got three different values, if you will, on this particular investment. There's current value, there's annuitization value, and there is cash value, for if you include the death benefit. So when you look at these numbers, it's very easy to get confused. It's very easy to get deceived, really, in terms of how these products work. Because as you look at the statement, you say, oh, I put in 80,000, it's worth 226. Yeah, I must be doing okay. The problem is that there are three things that sort of should make you, begin to make you a little bit uncomfortable with what's going on here. Number one is that cash value. Why is that cash value so low? Cash value is only $95,000. This is an investment that this person has owned since 2004. So 16 years of owning this investment that I put $80,000 into. If I needed a chunk of money, I'm only going to get $95,000 for it. That's the number. The first number should be catching your attention and thinking, that seems kind of weird. Let's continue. Here's the other number. So, okay, I put 80,000 in, I got a 10% bonus, and it's now 226,000. What if I had just put in the 80,000 back in May of 04? What would that be if I had put it into just, broad-based market investment, the S&P 500? Well, that's this chart that we did. The reality is, had you invested 80,000 in May of 2004 and simply put it in a broad-based S&P 500, today you'd have $281,000. Well, wait a minute. I thought the ad said I could get all of the upside of the market. 226 is not 281. 226 is only like 2/3 of that 281. What happened? Must be some fine print in there. Biggest fine print in these is that they eliminate the reinvestment of dividends. That's a big part of market performance. The reality is that you didn't get all the upside of the market. Had you been able to control your emotions, you would have had a 30% better return. You would have had $281,000 versus 226. And here's the real kicker: the 281,000, you could have called and used all of it, because that would have been actually your money. Remember, the 226 is not your actual money, because now this gets into the third piece of the equation where the numbers again start to get a little odd. So I've got 226. What are the options for getting it? Well, in this particular case, we called and said, okay, what are the options for getting it? Because if we can only get cash value of $95,000, what are the options? Well, here you get the annuitization. Again, holding it up for our YouTube audience. Here you get the annuitization quotes. And remember, when you annuitize, you instantly convert over the contract, the insurance contract, because that, after all, is what an annuity is. You instantly convert it over to an income stream. So in this particular case, we took the best case option that we could get on the annuity stream, and that was basically a installment for life with a 10-year certain. Remember, this person who bought it when they were the age of 73. Now they are age 89. So doing a life payment for an 89-year-old, I'm not sure I would ever recommend that, right? Because at 89, you don't know really how much longer you got. Hopefully you still got a number of years in front, but the reality at 89 is you don't have that many more in front of you. At 89, taking a life installment wouldn't make any sense, because if you pass away 2 years down the road, then that's it. There's no more money. If you go with a 10-year certain, at least you know you're going to get the payouts for that 10-year period of time. So in this particular case, that was the best way to actually get up to that 226,000 number. But understand the time period we're talking about. She owned the product for 16 years, and now we've got a payout for 10 years. That's a 26-year period of time in order for you to ever get back what it is that you put in. If you run the numbers on it, on your $80,000 over a 26-year period of time, you only actually made $146,000. And you never had access to be able to get that chunk of money out, and you only had the option to have that money trickled out to you over a period of time. Don't be confused on these products. They're much more complicated than the advertisements let on. It's important, as always, with any investment, to make sure you run the numbers, ask the questions, and get an understanding of the fine print, particularly on these equity index annuity products. We'll be back after these messages here on Dollars and Cents with Joel Garris on News Radio WFLA Orlando. Welcome back to the program. This is Joel Garris. I'm a certified financial planner and certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful financial plan that will provide you with peace of mind for the future. The show, Dollars and Cents, one of the top 25 financial planning podcasts on the World Wide Web, just crossed a pretty amazing threshold. We've got over 10,000 downloads of our podcast at last count. So pretty cool stuff. We're glad you've joined us either on the News Radio WFLA Orlando network or 96.9 The Game. This segment of the program, we're going to ask the question, to roll or not to roll. Many folks are finding that their employment situation these days is certainly in a state of flux. Many people are finding that they're having to change jobs or change careers, particularly as a result of the impact of COVID, and they are confronted with a decision as to what to do with their 401k, their 403b, those types of retirement plans that they had with their prior employer. And so we wanted to take this segment to sort of talk through what your options are when you leave your employer and why it's important to sort of understand the differences in those options that you have when you decide to change employers, whether you decide, or in the case of many people these days as a result of COVID, you're forced into making a change. So what are the main options that you have as it relates to an employer plan that you have? Well, again, a lot of the options that you have don't really exist if you're still working, right? So this analysis really only applies if you've had a job change and you have an account with a prior employer, whether it's a 401k or a 403b. Those are the types of situations that we're talking about. And in those cases, you basically have three options. Take a lump sum, you can leave it alone, or you can roll it over. So we're going to go through each one and kind of talk through the pros and cons and ultimately come to a conclusion for what most folks generally want to do if they find themselves in this particular situation. So the lump sum, let's get this one right out of the gate. That's by far the worst option you can choose as it relates to your retirement dollars, because a lump sum basically pays you out cash. And the reality is, when it does that, there's a mandatory tax withholding at 20%, so that comes off the top, and now you're stuck with 80% of your money, and then that 80% or even the 100% is fully taxable, and if you're under 59 and a half, there's a 10% penalty. Now, obviously the reality of COVID and the current state of the economy has made that choice of cashing out your company retirement plan or your former employer retirement plan a tempting option. Let's face it, a lot of folks are struggling financially, and they may view that option to grab that money as very tempting indeed. And the reality is that the folks in Washington understand that and have acknowledged that, and so they have actually made it a little bit easier or more tempting to use that money. How have they done that? Well, they've eliminated the penalty that would typically apply, which is 10%, on taking money out of a retirement plan if you're not age 59 and a half. So the only thing that you're going to be responsible for if you do a distribution or a cash out, take a lump sum in this year, is just the taxes. So that's tempting. It's a little less taxable, but the reality is that what you're doing is you are eroding your retirement. So you really want to think of that lump sum option really as the worst option, really as the option of last resort, because it really should be. You're rating your retirement. The tax implications aren't quite as bad because they've eliminated the tax penalty these days, but it's still an early raid of your retirement. Obviously, if you're in a financial bind, there's not really any other choice. You don't have an emergency savings account, then it becomes a very tempting location to get it. But if you can try and use that as the option of last resort, because not only are you generating taxes, but you are completely undermining your retirement. So try and use that one as the option of very last resort. The next option, leave it alone. That's certainly an option. You shouldn't be forced into a decision anyway. You may want to catch your breath. Life is very different these days, and so to try and just leave it alone, that's certainly an option. The problem with that is that be aware that if your balance is smaller, like under $5,000, a lot of company retirement plans will have automatic distribution provisions where they will basically kick you out the money regardless, unless you make a move and move it over to someplace else. They'll just go ahead and distribute out the money automatically. So be aware of that leaving it alone may be fine for a period of time, but sometimes you may get forced into them cutting you a check. And that's a situation that you don't want to avoid, because if you wanted to try and not take that money, when they cut you a check, they're going to withhold 20% for taxes. So when you try and then subsequently roll it over to a retirement account, you've only got 80% of the money. The 20% is missing because it went off to the IRS. Well, then that means you have to pay taxes on that 20% that went off to the IRS, even though you never saw it. So be very careful of that trigger that can happen should you leave it alone, because you may very well find that it gets paid out. And the reality is, look, let's face it, you're now an ex-employee, less in the loop of what was going on with that company. So leave it alone is fine as a temporary solution, but we don't think that is the best solution. We think the next option becomes the best solution, which is that you roll it over. And when you roll it over, it's basically a paperwork process. Again, you don't want to take the check, you don't want to take the cash, because what happens there is that you've got these tax implications that you've got to deal with. So your two options are, you can roll it over to your next employer's plan. You can certainly do that. Beware on that one, though, that oftentimes, and we're seeing this sort of across the board, is that a lot of 401k plans are very limited in terms of their investment options, and access to it can also be limited should you need that money down the road. The best option, we think, is really rolling it over to an individual retirement account, assuming it's pre-tax. If it's post-tax, make sure it goes to a Roth. Different conversation, but we wanted to make sure we added that part in. On an IRA, you've got the greatest amount of flexibility, plus a much greater investment spectrum of which to choose from, and also your access is better. Again, either of those options, whether you roll it over to your next employer's company retirement plan, or you decide to take control of it directly through an IRA, an individual retirement account, they both require paperwork, because that paperwork is crucial so that you don't run into any tax conversations. Speaking of company retirement plans, 401ks and the like, one of the big investment options that you see, and pretty much only the only investment options that you see in a lot of them, are these target date plans, these target date funds. And we, for many years, have not been a proponent of those target date funds, because what we were seeing was this trend where more and more target date funds were coming in, but more and more individual funds or individual options were getting eliminated. Well, our opinion on that has become more justified than ever, thanks to the latest data out of Morningstar as it relates to target date funds. We're going to slide to a break, and when we get back, we're going to describe a little bit more of that data, and then we also still need to tear in to Social Security. We talked about that at the beginning of the program. We want to certainly get to that as well. So we're going to wrap up the target date stuff, and we'll shift gears over to Social Security coming up next here on the program. This is Dollars and Cents with Joel Garris of Nelson Financial Planning on News Radio, WFLA Orlando, and 96.9.